this is the Chapter 11 demonstration, and this is our last demonstration for the semester. We are going to start with the demo doing payroll. That's my favorite part of the whole class. We will work with a couple other things as well. We'll talk about warranties, product liability suits, and our last ratio for the semester. Okay, so with payroll, make sure you printed out your demo for Chapter 11. And this is the CBiz companies. They pay their employees each week. And you'll notice that we have 4 employees here. This is their gross pay through September 23rd of the current year, and then how much they earn for the week. And then this is their federal tax. The federal tax is based off of your W-4 form that you filled out when you started the job. And it will tell your employer if you're married or single, and it authorizes them to take the federal tax out of your check. It's on a table that they go through and figure out how much your federal tax is based on your gross pay for the week. All of you are also, besides your federal income tax, you have Social Security and Medicare that come out of your checks. These are real world numbers here, 6.2% and 1.45%. And we'll talk about FUTA and SUTA in just a little bit. Now, Social Security and Medicare we will address first because those are part of the employees that comes out of their checks. So we will go through and calculate out the Social and the Medicare, the take-home pay, and then we will journalize the paying of the payroll. And then we'll also talk about some of the things that the employer pays as well. Now, you'll notice here that says Social Security is applied to the first 137,700. Here's a little history of Social Security, and it started in 1937, and you can see how much the maximum was for each year. Now, what that means is that once you make up to that amount, then no more Social Security comes out of your check until the beginning of the next year. So if it's July and you're a highly compensated employee and you hit your maximum, whatever it is for the year that the payroll is for, then you don't have to pay Social Security until the beginning of the next year. Now, our book is the edition, it was written in 2020, so the maximum that they use for all of your problems is 137.7, and we'll be using that for our demo as well. Now, you'll see that here in 09, 10, and 11, Social Security maximum stayed the same. That was because we were in a recession at that time. And during 15 and 16, it stayed the same as well, and I don't remember why that had stayed the same, but those 2 years, the maximum stayed at 118.5 as well. Alright, so again, like I said, the maximum for the Social Security is 137.7, and Social Security is 6.2% of your check, and Social Security helps pay for people who are eligible to draw Social Security for retirement, and you can pick 62 or any year up to 72 when you turn, and then if you don't start taking it at 72, they'll automatically start giving it to you at 72. It also pays for people who are disabled. It also pays to people who have lost a spouse, or it also pays to children who have lost a parent. So again, we're going to work with a maximum base of 137.7, and again, from our table here, we have the gross pay for all of our employees through 9/23, September 23rd of the current year. And I'm going to write the names of our employees up here at the top. So we have Allie, Eve, Hong, and Juan. Earned through September 23rd of the current year, Allie has made 136,100. Eve has made 136,185. Hong has made 6,650, and Juan is at 23,700. Now, as you can see, Juan and Hong aren't even close to the maximum base for Social Security, so they will be taxed on the full amount. So earned this week for Allie is 2,500. Eve is $1,515, Hong is $475, and Juan is $1,000. So because Hong and Juan aren't close to that maximum base, they will be taxed on their full pay for Social Security. Now with Eve, if we take her, 136, 185, and add 1515, that takes us right up to that maximum. So the next week, Eve will no longer have to pay Social Security out of their check as well. So subject to tax is 1515. Okay, now Allie made $2,500. Now Allie is at $136,100 for gross pay. If we add $2,500 to that, that puts Allie at $138,600. Now our maximum base is $137,700. So if we subtract that, whoops, wrong amount. That is $900. So $900 is over the maximum, okay? So what we need to do is if we take, again, the $136,100 and we take away $137,700. Sorry, I said that wrong. So if we take the $136,100 and add what Allie made for the week, we're at $138,600. We subtract $137,700, and that puts Allie over by $900. So we're going to take the $2,500 that Allie made for the week, subtract $900, and we're going to have to pay Social Security out of Allie's check based off $1,600. And then if we add that to $136,100, that's going to put Allie right at the $137,700. So $900 of Allie's check is not going to be subject to Social Security tax. So Allie will only have to pay part of Social Security this pay, and then next pay, and through, so that will be all of October, November, and December. So 3 months with no Social Security. So that's a nice thing. Okay, now with that, again, the percentage for Social Security is 6.2%, or in decimal form, 0.062. Now, payroll is an exact science. We don't want to overpay or underpay anybody any money at all. So, what we want to do is use our rounding rules and be very careful when we're calculating out the Social Security, Medicare, and any other taxes. So, 1,600 times 0.062, that gives us $99.20 for Allie. 1,515 times 0.062, that is $93.93. 475 times 0.062, $29.45. And 1,000 times 0.062 is $62. So that is the Social Security out of each employee's checks. Now, to help us in a little bit here, I'm going to add up all my Social Security taxes here for all 4 employees, and that equals $284.58. So I just added up everybody's Social Security tax, and that equals $284.58. Now, with Medicare, everybody pays Medicare no matter how much you make, and Medicare is the health insurance for people who are on Social Security. So, with that, we're going to, again, put how much each employee has earned for the week. So $2,500 for Allie, $1,515 for Eve, $475 for Hong, and $1,000 for Juan. The tax rate is 1.45% or 0.0145. So if we take 2,500 times 0.0145, it's 3625. So far everything is coming out okay. We haven't had to do any rounding, but again, make sure you use your rounding rules. Oh, this one did. Okay, so this is 2196.75. So we're going to round to 2197. We'll round that up using our rounding rules. 2197. 475 times 0.0145, that gives us 688.75. So that's going to be $6.89. And then 1,000 times 0.0145, and that's $14.50. Again, you don't want to short anybody money or overpay, because if you overpay, then you have to take it back out of their check. We're going to add up our four Medicare for all four employees, and that equals $79.61. Okay, now the next thing that we're going to do here, you'll notice here that it says FICA, F-I-C-A. For 5 extra credit points, you're going to email me what FICA stands for. All you have to do is just Google it, type it into an email, do not copy and paste, and tell me what FICA stands for. What does FICA stand for? So email that to me in an email and label it extra credit or whatever you want to for the heading in the email, and look at the due date in Canvas for that, and you're going to again email it to me. What does FICA stand for 5 extra credit points? Okay, now we have all of that, and so what we're going to do next is we're going to skip down here to step 7, and we're going to figure out everybody's take-home pay. That's what we actually get in our check. And some people have their checks direct deposited, some people still get an actual payroll check, and some people get that dreaded payroll card, which I totally do not suggest that you ever get if your employer offers it to you. If you have a choice, don't get it. If you don't have a choice, you'll have to get it. But a lot of times there's fees even to just get your own money off your payroll card, and you work hard enough, you don't need fees taken out of your payroll check. So again, if it's at all possible, make sure that you don't get the payroll card. Use direct deposit, which is the greatest invention ever, or if your company is small enough, they still might write you a payroll check. Okay, so way up here at the top, let's write Allie, Eve, Hong, and Juan. But we're going to go down here to number 7, okay? So again, Allie made $2,500 this week, and Eve made $1,515. Hong made $475, and Juan is at $1,000. That totals up to be $5,490 for the gross pay for all of our employees. Now for the Social Security, we already calculated that out, so I'm just going to take the numbers that we have here and put it on the line. So we have $99.20 for Allie, $93.93 for Eve, $29.45 for Hong, and $62 for Juan. Again, total $284.58. Social Security, Medicare, we already calculated out the Medicare. $36.25 for Allie, $21.97 for Eve, $6.89 for Hong, $14.50 for Juan, and that totals be $79.61. Now the withholding taxes means the federal tax, and that's what's on your chart here, your table. So I'm just going to copy those down, and we have $198 for Allie, and we have $182 for Eve, $32 for Hong, and $68 for Juan, for a total of $480. Now health insurance, in our instructions it says, in addition to gross pay, the company must pay 1/2 of $100 per employee's weekly health insurance. So the weekly health insurance is $100, the employees pay half, the employer pays half. So everybody pays $50 for health insurance. That's pretty cheap. And so that gives us a total of $200. Now, take-home pay, you take the gross and subtract out the taxes and the insurance. So we will take Allie, $2,500 minus $99.20 minus $36.25 minus $198 minus $50. Take home is $2,116.55. $2,116.55. All right. Doing the same thing for Eve. Take home is $1,167.10. Same thing for Hong, $356.66. And the same thing for Juan, $805.50. And then we're going to take the total gross and subtract out the total deductions here. That gives us $4,445.81. And then you can double check that by taking the take home and add all four of those together, and you should equal that same total. So the employer paid everybody to work for the week $5,490, and then this is the gross or take home after all the taxes have come out and each employee is listed there. Now in the real world, you do have Social Security and Medicare coming out of your check. Those are real world numbers, 6.2%, 1.45% for Medicare. Federal tax is based off of the tables and if you're married or single. And the last thing that isn't on here is state tax. We in Michigan have state tax. Our state tax in Michigan is at 4.25%. So if you didn't know that that's what that is 4.25% for Michigan. Now, Michigan is a state in which we do have state income tax, but there are some states in the United States that because of a revenue source, those states, the employees do not have to pay state income tax. One being Florida. Florida is a very highly toured or has high tourism, and so with the revenue coming in from tourism, the employees in the state of Florida do not have to have state income tax coming out of their checks. So for another 5 extra credit points, please email me the states in our United States that do not pay state income tax. Don't get it confused with sales tax. State income tax. Again, there are several states in the United States because of a revenue source that they do not have to have income tax coming out of their check. So email that to me as well. You can put it with the FICA if you want, or you can send it as a separate email. Either way is fine. Okay, so that's the take-home pay for the employees. Let's go ahead and journalize that, and then we'll come back and do the second part of that. Okay, now, for the entry, these employees are being paid on September 30th. We're going to write all the titles in and then we'll throw in the amounts, okay? Alright, so our first one is salary expense. You've seen that title before. Our next title, put FICA, F-I-C-A, dash, S-O-C, S-E-C-T-A-X, P-A-Y, Social Security tax payable. Next one, list FICA, Medicare, tax, P-A-Y. The next one is for our federal tax, E-M-P, F-E-D-I-N-C, T-A-X, P-A-Y, employee federal income tax payable. Next one is E-M-P, M-E-D-I-N-S, P-A-Y for employee medical insurance payable. And then the last one here is salaries payable. Explanation, record, employee, payroll, and this is from September 23rd. Alright, so all of those titles that are up there, you'll notice that they all have a payable on the end. Social, Medicare, Fed tax, employee, medical insurance, and then your salaries payable. These are all liabilities because they have payable on the end. What happens is that we post the Social Security to the ledger as well as the other payables, and then we're responsible to send those to the appropriate government agency once per quarter. So we would have a separate ledger for Social Security, Medicare, Fed tax, insurance, and salaries payable. Now with the Social and the Med and the Fed, again, we have to send that in quarterly to the government. So once we finish up the quarter, which this one's going to finish up this quarter, so we would go ahead and pay by the middle of October. We would pay for July, August, and September, all the Social Security, Medicare, and Fed tax that we took out of the employees' checks. We can't keep the money. It's a liability because it has payable on the end. And then we'll go ahead and just keep, once it's paid, we just keep on with the next quarter and so on. All right. And then the salaries payable, that sets the money aside into that payable until we actually go ahead and pay our employees. Now, our salary expense is going to be gross, okay? This is our gross pay. So that's our debit for $5,490. So I'm going to put gross pay. Now, all of your payables, your liabilities, these are the numbers that we're going to use here, and those are all going to be credits. So Social Security is $284.58, and then we have $79.61 for Medicare, $480 for Fed tax, and $200 for our medical insurance. Now, the salaries payable, that's going to be the take-home pay total. So that's going to be $4,445.81. I'll put a little note over here, take-home. So that's the take-home pay for all the employees. So that records the payroll for September 23rd, and then we're not going to post it, but we would go ahead and post that, and then on the pay date, which would be the 30th, then we would go ahead and post that. Actually, I'm going to change this date to the 23rd because it's through the 23rd. So we're going to change that date. Then we'll pay them on the 30th. Okay, no, I'm sorry, that's wrong. We'll leave it the 30th. We'll pay them after that. Okay. Now, the next part of the payroll demo deals with the employer's aspect of payroll. So, your employer, by law, has to match your Social Security and Medicare dollar for dollar, cent for cent. So, for this company, for the CBIZ company, they had $284.58 that the employees had taken out in Social, and $79.61 was Medicare. Not only do the employees pay this in, but the employer pays the match, dollar for dollar, cent for cent. And that's to help with both of those government agencies or government items for Social Security and Medicare. So these get matched dollar for dollar, cent for cent. Now the other part, which is on step 5 and 6, also, besides paying you to work, so your hourly or salary, your Social Security and Medicare match, your employer also has to pay into the federal and state unemployment system. Now, federal and state unemployment, federal is a smaller amount, state is a little bit bigger, but if you are if you have lost your job due to no fault of your own, that means, attendance, if you're late all the time and you get fired, that was your own fault. You can't draw unemployment. But if you get laid off, then you can go and draw unemployment. Or if your company closes up and you lose, you have your job totally eliminated, then you can go draw unemployment as well. So if you're a seasonal worker and you get laid off for the winter, if you do summer, or you get laid off for the summer because you do winter, then you can go draw unemployment for that time that you are off. Now, there is a maximum base for both, and it's $7,000. I guess we'll just leave it like that. There's no line for that. And with that, then, excuse me, this is our September 23rd pay. And what we're going to do is we're going to look at how much each of these employees made through 9/23. All right, so again, Allie's at $2,500. And Eve made $1,515. Hong is at $475, and Juan is at $1,000. Now, earned through 9/23, Allie is at $136,100. Eve $136,185. Hong is at $66,50, and Juan is at $1,000. Now, Juan's not even close to the $7,000 cap, so I'm sorry, I wrote this down wrong. It should be 23, sorry. 23,700. Juan is not even close to that 7,000. We're way over that, so no federal unemployment. Hong we'll come back to. Eve, way over, and Allie, way over. Now, with the employer, you only have to pay this on the first $7,000 that the employee earns, and then once that is done, you're done until the beginning of the next year. Now, with that, let's look at Hong. Hong is at $6,650. If we add $475 to that, that puts Hong's gross at $7,125. $7,125. So with Hong, we can take away the 125. So 6650 plus 475 puts him at 7125. So we can subtract the 7,000 again, and we're at 125. So we subtract that away from the 475, and the employer only has to pay on the $350, not on the whole 475, because that would put over the 7,000. So if we do 6650 plus 350, that's at 7,000. So we only have to pay on the first 350, not the full 475. So that's a good thing. Now, federal and state unemployment can change in your problem, so you need to watch for that. Social and Medicare will stay the same, but your federal and state unemployment numbers could change. For our demo, this is at 0.6%, or in decimal 0.006, okay? Now, it's the same thing with the state unemployment. The cap is 7,000. So Eve, Allie, and Juan, there is no subject to tax. Now again with Hong, we'll just have to do it on the 350. Oops, wrong line here, sorry. 350. And this is at, in our book, for our demo, your book might show different, is 1.75% or 0.0175. Now, depending on what industry you're in, the rate is going to be what drives that. So if you're in a industry where you would lay your employees off more often, like construction or landscaping, putting in pools, things like that, then you're going to pay a higher rate than you would for, maybe teachers getting laid off or office people, things like that. So Again, it's driven by your industry. So again, watch your book, watch your problems, because it's going to be different for all of them. Okay, now again, we don't have any federal unemployment for Allie Ever 1. We have 350 times 0.006. That's $2.10 for hung. And for the for the state unemployment, we have 350 times 0.0175, and that's 6.125. So we're going to use our rounding rules, and that'll be $6.13. So our total is $210 for FUTA and $613 for SUTA. And you can abbreviate those as we go through that, SUTA and FUTA. Okay, so down here at the very bottom, you have the employer's total payroll. All right, so gross again is $2,500 for Allie, $1,515 for Eve, $475 for Hung, and $1,000 for Juan, for a total of $5,490. Now for Social Security, remember we match that dollar for dollar, cent for cent. So what we have up here for Medicare and Social, we're just going to write below. So $99.20 and $36.25 for Allie, Social, and Med. $93.93 and $21.97 for Eve. Hung, $29.45 and $6.89. For Juan, $62 and $14.50. Total Social, $284.58. Total Med, $79.61. Now, federal unemployment, remember it's just $2.10 for Hung. This does not come out of his check. This is the employer side. And then we have $6.13 for Hung. Remember the health insurance, the employer matches the $50, so that will be for all 4 employees for a total of $200. I forgot to put the totals for $613 and $210 next to FUTA and SUTA. Now, pension. The employer or the company contributes an extra 5% of the employee's gross pay to a pension fund. So the employees get that added benefit. The employer puts 5% of their gross into a pension plan, to a pension plan. If you, as a worker, are offered a 401k, you need to jump into that early on in your work life. What that is it is a pre-tax amount of money that comes out of your paycheck, and it goes into a fund. And then when you're ready to retire, you can start taking that out at age 59 and a half. Now with that, you can have quite a nice nest egg. Now I know some of you are very young and you're thinking, that's the forever for me. If you're 18, that's 41 years away. Well, that 41 years, I can tell you, is going to go fast. It's going to go super, super, super fast. So you want to shove away as much money as you can. Depending on the year, you can put away so much money, and then when you do hit 50, you can do what they call the catch-up, and you can put extra money in there as well. Now, this is a great opportunity for you to start building that nest egg for when you retire. You can take this with you from employer to employer as long as you roll it over. You do not want to leave it with your other employer if at all possible. I suggest you put in the maximum amount every week. You won't miss it out of your check, especially if you are a single person. But if you're feeling that you'll be a little tight, at least do what the company matches. Like if the company matches 6%, you put in 6%. If they match 3%, you match 3%. Because again, it is a great opportunity. When my husband started at General Motors at age 22, I think he was, 22, he started with a 401k. He left General Motors after 19 years because he took the buyout. He was tired of moving around for General Motors. But he kept that money in with GM because that was a good thing to do at the time. But when the older guys there that kind of mentored him and things as being an apprentice at GM. They told him, you put in the max every week and you'll have $1 million. Well, way back in 1992 when he started at GM, $1 million seemed like that would be a lot of money. But with inflation and things like that, you never know. So you put it into funds, you can decide where it's going to go and put it into different funds and you can grow it. Some of you that already have this, you already know about all this, but you younger people who don't, you need to know that this is a great opportunity for you to be able to have some money when you start for retirement. A lot of companies today do not offer a pension fund. Some do, some don't. I was very lucky as a retired teacher to have a pension, so that's a fortunate benefit for me. But a lot of companies don't have pensions anymore, so it's a way for you to save for the future. And then if you need a financial investor person to help you, get them and have them help you with what to put the money into. Luckily, my son and my husband always talk about it and they know what good places to put the money is. So please do that. You don't want to work forever. You want to enjoy part of your life that you have worked so hard for during all those years. And again, you can retire how you want to. If you want to retire at 40, or if you want to retire at 55, or you want to retire at 65, or you want to work till you're 80, that's up to you. But again, please consider a 401k. All right, that's my lecture on that. So 5% of the employee's gross pay. So it would be 5% of Allie, 5% of Eve, 5% of Hong, and 5% for Juan. So $125, this is going to be 5%. So $125 for Allie, $75.75 for Eve, $5.26 for Hong, and $50.26 for Juan. Add that all up, and that's going to be $256.27. And we're just going to total up here all the different deductions: the social Medicare match, the SUTA, FUTA, health insurance, and the pension. It's $828.69. $828.69. Now to journalize that, we'll go back to our journal page here. Alright, so this is the 30th, and this is a new title. This is called Payroll Tax Expense. We're going to put our FICA, SOCSECTAXPAY. We're going to put FICA, Medicare, tax, PAY, and then we're going to put our FUTA for FUTA, that stands for Federal Unemployment Tax, and SUTA, which is your state unemployment tax, and then we have to put that employee, so put EMP, MEDINS, PAY for our employee medical insurance premiums payable, and we have our pension payable. Alright, now with that, we're going to have our explanation here, and then we'll throw the numbers in. So for our explanation, record employer's payroll tax. And again, we do this after each pay, whether it's every week, every 2 weeks, once a month, whatever. Okay, so our Social Security, again, we match what we have up here at the top, so $284.58 and $79.61. For our federal tax, it was $2.10. Our state unemployment, $6.13. $200 for the medical insurance, and $256.27 for our pension. Now, you're going to add up all of these credits, and that's going to be our debit to payroll tax expense of $828.69. $28.69. So on top of your employer paying you to work for them, they also have to match the Social and the Medicare, federal and state, until you make $7,000. This company contributes to the medical insurance and helps with a pension, so another $828.69. So we have the $54.90 that they pay for you to work there, plus the $828.69. That's $6,318.69. That's a lot of money, and that's why wages or salaries are the most expensive expense for a company. You have to have workers. I don't think anybody wants to work for free, but there are, rules that they have to pay their part as well. And again, these last two are optional, but they do have to pay the other four. So, very important for you to know all of that. I hope that you did learn that 6.2% does come out of your check for Social, 1.45 does come out of your check for Medicare. Federal tax, again, is based off the table and what you told your employer, married or single. And your employer has some responsibilities as well. These are by law. The first four here are by law. And if they don't pay those, they can be fined and maybe shut down, if it comes to that. So, again, very, very important for payroll. Exact science. We do not want to short anybody any money or overpay them either. Okay, so that is payroll. You'll have lots of practice with your homework. Now, the next couple things we have here, this deals with warranty for the next one for letter A. Now, this is like our allowance for doubtful accounts, and what we're going to do is we're going to set aside money in case the product that we sell needs to be fixed. Okay, now with that, you do have another journal page here, and I'll go through this. It says in September of 2021, Kern sold $140,000 of merchandise covered by a 180-day warranty. Prior experience shows that the cost of the warranty equals 5% of sales. So they think that based on past practices, 5% of their sales are going to end up being warranty work. So we're going to compute the September's warranty expense and prepare the adjusting entry for the warranty liability recorded at September 30th. And then we'll do another part of this in just a second. So again, we're setting the money aside like we did for our allowance for doubtful accounts. So this is going to be letter A and September 30th. New title, warranty expense. And another new title, estimated, just put EST, warranty, and then LIAB for liability. So estimated warranty liability. Explanation, record, warranty, expense, for month. Now some companies will estimate it for the year. Some of them base it off of each individual product, like if it's a copier or a big piece of machinery, something like that. But it just depends. You have to read your directions. Now, for the math, $140,000 in sales for the month. And they think that 5% or 0.05 will end up coming back for warranty work. So we're going to set aside $7,000 that goes to warranty expense, and the estimated warranty liability is a credit at $7,000. So because it says liability on it, it goes in our liability section of our balance sheet, and the warranty expense is an expense that goes on our income statement. So that sets that money aside in case we do have work. Speaking of work, also prepare a journal entry on October 8th to record a $300 expenditure to provide warranty service on an item sold in September. So, put letter B and October 8th. We're going to use up some of that money there. So we have our estimated warranty liability, and we're going to debit that $300. We set the money aside here. Now we need to use some of that. Now with this, because we're providing warranty service, that means that we're going to fix it. So we're going to go to our parts room and take some of our parts out of inventory. So parts inventory. And we will debit that, or I'm sorry, credit that $300. So we use up some of our parts that we set aside. Let's say this was a copier and we had to have some new parts for it. We go to the parts room, we take out what we need to fix the copier, end up being $300. And so we write that up by estimating, taking out the estimated warranty liability and then taking the parts out of our inventory. Explanation: provide warranty service. So again, with your homework for Chapter 11, you will have some practice with that as well. Alright, so that's letter A. Now letter B. In late December, Kern learns it's facing a product liability suit filed by an unhappy customer. Kern's lawyer advises that although it will probably suffer a loss from the lawsuit, it is not possible to estimate the amount of damages at this time. So you have a product, somebody gets hurt, and something happens with it, like way back when we had cribs that you could fit a kid's head in. People's kids' heads got stuck between the rails of the crib. There's product liability suits. So when you hear of recalls and things like that, or if you hear of a product liability suit, that probably means that somebody got hurt, like the Takata airbags or anything like that. Alright, so what do we do for letter B? Well, first we disclose the pending lawsuit. In the financial statement notes. So first we have to disclose the pending lawsuit in the financial statement notes. Although the loss is probable, no liability can be accrued since the loss cannot be reasonably estimated. So again, although the loss is probable, no liability can be accrued since the loss cannot be reasonably estimated. Companies do have liability insurance, product liability insurance, but it might go above and beyond that. So you do need to disclose the pending lawsuit in your financial statement notes, but it also needs to be brought to the fact that although a loss is probable, we can't set money aside at this point because we're not sure how much is going to be above and beyond possibly what our insurance is. Alright, so that's letter B. Last ratio. For the calendar year, Kern's net income is $1 million, interest expense is $275, and income tax expense for the year is $225. Calculate Kern's times interest earned ratio. This is how many times a company can pay the interest on their debt. Alright, so letter C, last ratio. This is times interest earned. And this is going to be your income before interest, expense, and income taxes divided by your interest expense. That's a terrible line. Okay, so we're going to take our income before interest expense and income taxes. So we take our 1 million plus our interest expense plus our income taxes divided by the interest expense, which is $275, and we get 5.45 times. 5.45 times. And that means that we're covering the interest on the debt 5.45 times. So I think that that's a pretty good times interest earned ratio. Again, comparing yourself from year to year, comparing yourself to your competition, it just all depends on what you are comparing to. Or again, you can set a goal for the year and making sure that that is what you're trying to hit. All right, now a couple things that I just want to discuss quickly. There is a serial problem for Chapter 11, and with the serial problem for Chapter 11, it is located in the back page or the very end of your Chapter 11 homework paper. So please make sure that you pull that out. Do all of your homework for practice for Chapter 11. Make sure that you do all of that. And then for the Chapter 11 serial problem, it's a payroll problem. And what you're going to do is you're going to use this information that is up here for just February 26th. Don't worry about March 25th. We're not doing that transaction. Her Addie Lynn, you remember Addie, or I'm sorry, Lynn Addie, I was getting her name mixed up. Lynn Addie, she works for Santana Ray here for Business Solutions, and her $1,000 of wages have deductions for FICA, Social Security, FICA, Medicare, and federal income tax. Her federal income tax is $159, so you got that. You're going to use the $1,000 as the gross wages for the time period, and you will calculate out her net pay. Then you're going to record the journal entry to reflect the employee's part, and then you're going to record the employer's payroll taxes. They give you the federal unemployment rate and the state unemployment rate. You'll match the social and the Medicare. You're only going to do steps 1, 2, and 3. Do not do step 4. So again, February 26th relates to Lynn Addie, and March 25th relates to step 4, which you're not going to cover. Just steps 1, 2, and 3. And then there is a separate video for the comprehensive problem that is after this, and this is on page 425 for the serial and the comprehensive problem in your textbook. If you have the ebook, again, it's on the left side of your Connect ebook information. Now, with the comprehensive problem, please watch the video so that you can get help with how to do the comprehensive problem so that you're not being frustrated with the end of the semester right around the corner. So, again, serial problem 11 is on the top of page 425. And then, again, watch the video to help you with the comprehensive problem for getting all that information. All right, working on your homework, finishing up strong for the semester. Email if you have any questions, please.